Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at AleAnna.
If you find our talks useful, please consider subscribe, like, and comment underneath.
It really helps us out.
Yeah, definitely. So, usually when we analyze a stocks chart, there is a very recognizable rhythm to it, right?
Oh, for sure.
It looks like a heartbeat, or maybe a gentle, logical climb up a hill.
Right. It's usually a gradual accumulation or, distribution.
Exactly, because if you are watching your own portfolio, you can almost see the gears of the market turning in real time, just pricing in new information day by day.
Yeah, the market likes to take its time digesting data. It's usually a slow process.
But then you pull up the recent chart for AleAnna,
Oh boy, yeah.
and suddenly that gentle hill looks like a seismograph during a 9.0 earthquake.
It's insane.
We are looking at a stock movement of just sheer violence. I'm talking about a massive 46% spike. And it's packed with extreme head-spinning volatility. It's the kind of chart that immediately grabs you by the collar and just demands your full attention.
It really does. Because when you see a structural displacement in price that aggressive, it forces you to look under the hood.
You have to.
Right. To figure out if there is a real wealth building setup here for the listener, we have to look past the sheer shock value of that 46% number.
Right. We have to dissect the actual anatomy of the move.
Exactly.
Okay, well, let's unpack the anatomy of that technical breakout then, because we are not just talking about a stock creeping up a few percentage points on a good Tuesday.
Not at all.
We are looking at a rally from roughly $3.57 to over $7.60 in a highly compressed time frame.
The stock practically doubled in the blink of an eye.
Yeah.
And what tells the real story for anyone analyzing this kind of price action is where the stock broke through.
Right, the key levels.
Yeah, it didn't just drift higher on a breeze. It violently surged past its key moving averages.
Okay, break that down for us.
Specifically, it blew past the 50-day moving average, which was sitting around $3.26.
Okay.
And it totally shattered the 200-day moving average at $3.39.
Let's actually translate that for anyone listening who, might not stare at technical charts all day long.
Sure.
A moving average is basically just the smoothed out average price of the stock over the last 50 or 200 days, right?
Exactly. It tells you the historical trend.
Right. And when a stock is trading below those lines, it's essentially asleep.
Completely dormant.
But when it violently breaks through both of those lines at the exact same time...
Which takes massive force, by the way.
Yeah, and leaves that dormant trading range completely in the dust. I mean, it is the market ringing a massive alarm bell.
Oh, absolutely.
It means the historical trend is fundamentally broken, and the entire financial sector is being forced to reevaluate what the company is actually worth.
Right, and now it's testing a major resistance level at $8.
$8. Wow. But, a price spike without volume is just a ghost.
Yeah, it's meaningless.
Right. It doesn't mean anything if nobody is actually putting real money on the table. But we are seeing a massive surge in trading volume here, aren't we?
Huge. On March 26th, we saw 5.23 million shares trade hands.
Over 5 million.
Yeah, that is a 47% increase from the previous session. And it's roughly 5.6 times its average trading volume.
That is wild.
Well, volume is the footprint of institutional money, right?
Okay.
When an average day sees less than 1 million shares trade and suddenly you hit 5.23 million, that is not retail investors trading from their smartphones on a lunch break.
Definitely not.
That is serious capital repositioning itself. Large hedge funds and institutions, they cannot buy a position in one click.
Right. They'd spike the price too fast.
Exactly. They have to acquire millions of shares over a compressed period, and that leaves a massive footprint.
Makes sense.
So that 5.6x volume multiplier totally validates the breakout. But to understand the why behind this mystery momentum, we have to look at the macro catalyst that lit the match.
The geopolitical spark.
Exactly. What's fascinating here is the transmission mechanism between global macro events and local assets.
Right. How a headline halfway across the world moves a specific stock.
Precisely. We've seen a sudden, severe surge in geopolitical fears, specifically originating from the Middle East.
Okay, let's get into that.
Recent statements from President Trump included very public warnings of, quote, hell for Iranian noncompliance.
And just to be clear for you listening, as an analytical show, we completely strip away the politics here.
Oh, 100%.
We aren't taking sides or endorsing any viewpoints. Our job is simply to watch how the market digests the information.
Right. and the market digested those headlines as a concrete, severe threat to global energy supplies.
Because immediately following that rhetoric, WTI crude oil prices spiked over 3%, hitting $93.50 a barrel.
A massive jump.
And for you listening at home, WTI stands for West Texas Intermediate. It is one of the main global benchmarks for oil prices.
Right.
So when WTI spikes like that, it means the global market is panicking about an upcoming shortage.
Exactly. And when crude oil flirts with $95 a barrel entirely on supply disruption fears, it creates a massive, immediate tailwind for domestic-oriented energy plays.
The substitution effect.
Yep, the substitution effect kicks in. The market panics about Middle Eastern oil supply, so capital aggressively rotates into safe, secure, localized energy producers.
Like natural gas.
Actually natural gas, because they are insulated from that specific geographic chaos. AleAnna simply got caught in that massive updraft.
Okay, I hear that, but I have to push back a little here.
Go for it.
A geopolitical headline is kind of like throwing lighter fluid on a grill, you know?
Okay.
It makes a massive, impressive flame for a few seconds, but does it actually cook the steak? You need charcoal for that. You need a real foundation. So my question for you is, does this massive 5.6x volume surge actually signify smart money moving in permanently because they believe in AleAnna's core business? Or is it just day traders and algorithms aggressively reacting to the price of oil?
I hear your lighter fluid analogy. I really do. But I would argue you are underestimating how permanent institutional momentum can be when it establishes a new baseline.
Really?
Yeah, lighter fluid burns off quickly, yes. But when 5 million shares move, that is not an algorithm reacting for 10 minutes.
Fair point.
That is institutional capital deciding to build a long-term position because they see the operational charcoal you're talking about.
Okay, so the foundation is there.
If AleAnna didn't have the underlying foundation, that $7.60 price tag would collapse back to $3.50 by the closing bell.
Because there'd be nothing holding it up.
Exactly. They stick around because the business operations and the actual balance sheet justify a new valuation.
Okay, so let's cross the bridge from the macro headlines to the actual operational foundation. Let's look at AleAnna's business.
Let's do it.
They are an energy company, but their core fundamental strength, their moat, is entirely based on Italian natural gas assets.
Right. And that geographic specificity is their absolute superpower right now.
Why is that?
Well, their operational engine relies on two main pillars. First, you have Longanesi field, which is fully operational, currently pumping, and actively generating cash.
So it's already a proven asset.
Yes. And second, you have the recently approved Gradizza concession, which is their primary growth engine for the future.
So if you are analyzing this for your own portfolio, you might be wondering why being in Italy matters so much. I mean, gas is gas, right? Why is an Italian field so special?
If we connect this to the broader structural issues in Europe, the landscape there has been completely traumatized by supply insecurity over the last few years.
Oh, absolutely. The pipeline issues.
Europe is utterly desperate for domestic energy production, so they aren't held hostage by imported liquefied natural gas or vulnerable pipelines crossing through hostile territories.
Right.
By owning domestic production infrastructure, right there in Italy, AleAnna possesses a competitive moat that is incredibly difficult to replicate.
Let's break down the mechanics of that moat because it's genuinely fascinating.
And the logistics are crazy.
If a European country has to import liquefied natural gas or LNG from the United States or Qatar, the logistics are a nightmare.
An absolute nightmare.
You have to extract the gas, supercool it into a liquid.
Which takes massive facility.
Right. Load it onto a specialized multi-million-dollar tanker, sail it across the entire ocean, offload it at a specialized terminal, warm it back up into a gas, and then put it into the pipeline.
It's absurd.
That entire process costs an absolute fortune.
Yeah.
But AleAnna bypasses all of that. They extract the gas in Italy and pipe it directly into the thirsty Italian grid.
Exactly. And the economic result of bypassing that massive logistical chain is that AleAnna can capture premium pricing.
Ah, because they don't have all those overhead costs.
Right. Localized European pricing is often completely disconnected from global spot prices because of those very transport constraints you just mentioned.
Wow, so they can charge more while spending less.
If you have the supply sitting directly next to the demand, you bypass the shipping bottlenecks and you capture those massive margins.
And that operational reality is deeply reflected in their financial health.
It really is.
Let's talk about the balance sheet, because it is essentially a fortress.
A total fortress.
AleAnna is sitting on a cash reserve of roughly $31 million. They are generating $8.09 million in free cash flow.
Which is incredibly strong.
And their liquidity is exceptional. Both their current and quick ratios sit comfortably at 2.0.
And that quick ratio is a vital metric for wealth preservation.
Let's translate that for the listener really quick.
Please do.
A quick ratio of 2.00 simply means that if the broader economy crashed tomorrow and every single bank or vendor called in AleAnna's short-term debts all at once.
It's the worst case scenario.
Right, the worst case scenario. The company has exactly twice the amount of liquid cash on hand needed to pay off every single bill without breaking a sweat.
It's the ultimate measure of financial safety.
It really is.
And beyond the cash reserves, we have to look at their leverage.
Okay, the debt.
Right. In an environment where brutal interest rates have been suffocating capital-intensive exploration companies, AleAnna operates in a completely different reality.
Because of their debt structure.
Exactly. They have a highly conservative debt-to-equity ratio of just 0.03.
Wait, 0.03. Meaning for every $100 of equity value in the company, they carry a grand total of $3 in debt.
Yep. It is functionally zero debt.
That's incredible.
They are immune to the interest rate risks that are driving their competitors to bankruptcy right now. They have the internal cash generation to self-fund the drilling of the Gradizza concession without having to go to a bank and beg for a loan at like an 8% interest rate.
Okay, here's where it gets really interesting, though.
Uh-oh.
You just painted a picture of a flawless balance sheet, zero debt, and a deeply protected geographic moat. But I have to zero in on the valuation because the math is giving me whiplash.
Yeah, the valuation is a lot.
AleAnna is currently trading at a price-to-earnings, or PE ratio, of 188.
It is an exceptionally steep multiple.
It's astronomical.
Yep.
Let's walk through the actual math of what a PE of 188 means for you as an investor.
Good idea.
If I am buying shares in a business with a PE of 188, it essentially means that at their current profit levels, it would take 188 years for the company to earn back the exact price I am paying for the stock today.
A very long time.
I am paying a massive multi-generational premium just to get the keys to this exclusive European gas market.
Sure.
Especially when you consider they currently only generate about $1.4 million in quarterly revenue.
Right.
How on earth is the market pricing in enough future growth to justify paying $188 for every $1 of current earnings?
Well, the market is pricing in flawless execution and immediate massive scaling.
Flawless execution.
Yes, you are entirely correct that $1.4 million in quarterly revenue does not functionally support a $7.60 share price.
Right.
However, the stock market is ultimately a forward-looking discounting mechanism.
Meaning it cares about tomorrow, not yesterday.
Exactly. The counterweight to that 1.4 million figure is their recent financial disclosure, which indicates an operating revenue run rate hitting approximately $11.2 million.
Oh, okay. So the math is totally shifting under our feet.
The market isn't paying for what the Longanesi field produced last year while it was still spinning up its operations.
Okay.
The market is paying for the $11.2 million run rate it is currently projecting right now, coupled with the future upside of the newly approved Gradizza concession coming online.
That makes a lot more sense.
When you combine an $11.2 million run rate with zero debt and a $31 million cash pile, that 188 PE ratio transforms from a measure of current reality into a measure of massive future expectations.
So we have a company sitting on a pile of cash operating in a highly lucrative protected market with a stock chart that looks like a rocket ship.
Sounds perfect, right?
That sounds like a flawless textbook wealth building setup. But if the house is in such perfect order, why are the architects suddenly selling their shares?
Yeah. This brings us directly to the red flags.
We absolutely have to address the glaring bear case elements here, and the loudest alarm bell ringing for me right now is the significant insider selling.
The data on this is impossible to ignore. Over the past 3 months, insiders have unloaded 325,784 shares.
That's a huge chunk.
It is. And that includes a major shareholder, C. John Wilder, who dumped 82,260 shares at a price point of $4.17.
Honestly, seeing insiders sell 325,000 shares right before and during a massive breakout feels like watching the captain of a ship put on a life jacket while telling all the passengers to just enjoy the wonderful cruise.
That's a great way to put it.
I mean, if the Gradizza concession is such a gold mine, and that 11.2 million run rate is a sure thing, why is a major shareholder dumping 82,000 shares at $4?
It introduces a massive variable of risk into the thesis. There's no way around it.
Yeah.
And the danger is magnified exponentially because of how AleAnna's stock is actually structured in the market.
What do you mean?
This company operates with what we call a tiny public float.
Okay, let's break down the mechanics of a public float for the listener because it really dictates how the stock behaves on a day-to-day basis.
Definitely. The float is simply the number of shares that are actively available for the general public to trade on the open market.
Right.
A company might have tens of millions of total shares in existence, but if the vast majority of those shares are locked up in the vaults of company founders or massive institutions who refuse to sell,
Then you can't trade them.
right, the actual pool of shares changing hands every day is incredibly small.
Which creates a bottleneck.
Exactly. When a macro catalyst hits, like WTI crude spiking to $93.50 and millions of dollars in institutional buying volume pours in, they're all trying to buy from a tiny, restricted pool of available shares.
It's like a game of musical chairs, but there are only 3 chairs and 50 billionaires trying to sit down at the exact same time.
Yes, perfect analogy.
The price naturally explodes because nobody is willing to sell at the old price.
That supply and demand mismatch is the mechanical engine behind a 46% spike. But that sword cuts aggressively in both directions.
Oh, so.
The combination of a tiny public float and active insider selling creates a powder keg of volatility. If the buying volume suddenly dries up, or if insiders decide to flood that tiny public pool with thousands of their own shares, the stock can gap down and crash just as aggressively as it gapped up.
Which perfectly explains why the analyst community is remaining so skeptical. Because despite this massive bullish price action and the sheer volume of the breakout, Vice Ratings is still maintaining a strict sell rating on AleAnna.
They are running the math on that 188 PE ratio, factoring in the insider selling, and determining that the structural risk of a violent downward correction totally outweighs the current momentum.
It's a rational take.
However, to balance the scales, there is another speculative element moving the price action that we need to evaluate.
The M&A rumors, mergers and acquisitions.
Right. Unconfirmed market chatter, and it is vital to stress to you listening that this is currently purely speculative.
Very important.
But rumors suggest that AleAnna's low float and highly valuable, producing European reserves make it a prime acquisition target.
You know, the underlying logic of a buyout makes complete sense.
It really does.
If you are a massive European energy conglomerate and you are desperate for a secure, localized domestic supply, why would you spend 5 years navigating labyrinthine Italian bureaucracy?
Getting all the permits.
Right? Fighting for permits and drilling exploratory wells that might just turn up dry anyway.
It's way too much risk.
It is far easier to just buy AleAnna outright, take over their operational Longanesi field, and immediately own the supply on day one.
The premium a larger company would pay for that immediate operational capability would be significant.
Yeah.
And actually, to circle back to your life jacket analogy regarding the insider selling,
Okay.
seeing 325,000 shares sold is a concerning metric on the surface. But we have to look at the broader capitalization table.
The big picture.
Even after all of that selling, insiders still own almost 43% of the entire company.
Oh, okay, well that changes the framing entirely.
Right.
If you own nearly half the company, selling a few 100,000 shares might not be putting on a life jacket at all. It might just be the founders taking some chips off the table.
Exactly.
Think about it. If you've spent years grinding away, building an energy company through the highly illiquid, tedious exploration phase, and suddenly the stock spikes 46% in a week.
You're going to cash them out.
Yeah, you might sell a little just to lock in some personal wealth or, I don't know, buy a boat, right?
Yeah.
It doesn't necessarily mean you think the well is running dry.
It simply secures their personal financial position while keeping 43% of their net worth heavily aligned with the long-term success of the company.
So the alignment of incentives is still firmly intact.
Very much so.
So what does this all mean for you, the listener? We have this incredibly complex knot to untangle today.
We really do.
On one side, we have massive geopolitical macro tailwinds with oil prices, a pristine zero-debt balance sheet, and a fiercely protected European moat.
All great things.
But on the other side, we have an astronomical PE ratio of 888, extreme low float volatility, and insiders taking millions of dollars off the table. How should an investor actually synthesize all this conflicting data into a concrete wealth-building game plan?
When you distill all the operational data and the technical momentum, the setup earns an overall 7 out of 10 bullish rating.
Okay, a 7 out of 10.
But, and this is a critical distinction for portfolio management, it is categorized strictly as a high-reward, high-risk play.
Meaning this is absolutely not the conservative dividend stock you buy, forget about for 20 years, and pass down to your grandchildren.
No, definitely not. The time horizon dictates the strategy here. This setup is currently best viewed as a swing trade with a 1 to 3 month horizon.
A swing trade.
Yes, a swing trade isn't about long-term fundamental holding. It is a highly leveraged instrument designed specifically to capitalize on near-term geopolitical volatility and technical momentum.
Okay, so if I'm managing my own portfolio and looking at the next 1 to 3 months, what are the exact catalysts I need to circle on my calendar? What actually moves the needle on this trade?
There are 3 specific catalysts that will determine if this breaks higher or collapses.
Okay, what's the first?
First is the macro level. You have to actively monitor the Middle East and Iranian sanctions. Any escalation or rhetoric that keeps global oil and gas prices elevated directly drops to AleAnna's bottom line.
Because the higher the global panic over supply chains, the more valuable their localized, pipeline-connected Italian gas becomes.
Exactly. Second is the company level. You need to watch for concrete development updates on the Gradizza concession.
The new growth engine.
Right. Management has highlighted this specific asset as their key to organic upside. Because the market is pricing in absolute perfection with that 188 PE, management needs to announce tangible milestones, proving that Gradizza is moving toward commercial production exactly on schedule.
So we're watching Middle East tensions and Italian drilling updates.
Yep.
But none of that matters if the actual money isn't hitting the bank account. I'm assuming the third catalyst has to be the upcoming earnings report to prove that 11.2 million run rate is actually real.
You nailed it. The market-level catalyst is entirely dependent on that earnings release.
It always comes down to earnings.
It does. The market needs mathematical validation of that $11.2 million operating revenue run rate.
Oh.
Furthermore, investors need to see exactly how management plans to deploy that $31 million cash pile.
Right. Are they going to aggressively drill new wells?
Are they going to acquire more land?
Yeah.
How they deploy that capital will signal their true internal confidence in the future of the European gas market.
It really all comes back to risk management for the listener, doesn't it?
Around 100%.
If you were going to step into a trade with a tiny public float, where the stock can jump 40% in a day, you have to ruthlessly protect your downside.
You have to.
You are paying a massive premium, which means the market has priced in zero room for error. If those Gradizza updates are delayed by even a month, or if the earnings release shows the run rate slipping from 11.2 million down to 9 million,
it's going to be ugly.
yeah, this stock won't just slowly decline.
Yeah.
Because of that low float, it will violently correct.
AleAnna is essentially a microcosm of the current global economy right now.
That's a great point.
It's a high-wire act balancing directly on top of geopolitical instability and energy security fears.
Let's recap this core dynamic for you because it is a fascinating case study in modern market mechanics.
Really?
AleAnna is a high-leverage instrument for playing European energy security. It is backed by incredible zero-debt financials and a massive cash pile.
Right.
But it is deeply complicated by a sky-high valuation, intense daily volatility driven by a tiny float, and the seemingly contradictory signal of insiders selling off shares while still retaining massive ownership.
Navigating this requires active management, strict stop losses, and a clear-eyed view of the mechanical risks.
Yeah.
And certainly not for the faint of heart.
Which brings us to a much broader wealth-building question, something for you to ponder long after we wrap up here today.
Okay, let's hear it.
We talked earlier about that 9.0 magnitude seismograph chart. We saw exactly how quickly the market violently re-rated AleAnna the second global supply fears spiked.
We're ready.
So if geopolitical instability and localized energy scarcity are not just temporary panics, but the actual new normal for the global economy.
Oh, wow.
Right. How many other overlooked low-float domestic producers are sitting out there right now?
That's the real question.
How many other companies are quietly sitting on geographic gold mines, holding pristine zero-debt balance sheets, just waiting for the market to suddenly wake up and realize what they are actually worth?
Finding the operational charcoal before the geopolitical lighter fluid hits it?
Exactly.
That is the true multi-million-dollar question.
Thank you for joining us for this analysis. Keep questioning the charts, keep looking past the headlines to understand the underlying mechanics, and keep exploring the intersection where macro events meet individual stock fundamentals. We'll catch you next time.